In the last 18 months, the Carlyle Group quietly deployed more capital into defense and national security than at any point in its 37-year history. Not into the legacy primes, not Boeing, not Northrop, but into the unglamorous high-margin infrastructure underneath them. Signals intelligence, cybersecurity platforms, autonomous logistics, and government IT architecture. The question isn't whether defense is a good macro theme. That argument was settled when NATO members started hitting 2% GDP spending targets for the first time in a decade. The real question is, Carlyle has access to deals you will never see, at valuations you will never touch. So what does that tell you about where to position in the public markets? And what does the smart money know about this sector that the average defense ETF buyer is completely missing? Let's establish what Carlyle actually is before we talk about what they're doing. Because conflating private equity with stock picking is where most of this analysis goes wrong. Carlyle manages approximately $425 billion in assets under management across private equity, credit, and real assets. Their defense and government services portfolio has historically been one of their core verticals. They've owned companies like Booz Allen Hamilton, which they took public, and Mantech International, which they took private in 2022 for $4.2 billion. That Mantech deal is instructive. At the time, Mantech traded at roughly 20 times EBITDA, expensive by most PE standards. Carlyle paid it anyway. Why? Because government IT and intelligence contracts are essentially recurring revenue businesses with a single, creditworthy counterparty, the U.S. federal government. The revenue doesn't disappear in a recession. It doesn't get disrupted by a new competitor overnight. And the switching costs, once you're embedded in a classified program, are nearly insurmountable. What Carlyle is doing now is doubling down on that same logic, but moving further up the technology stack. They're not buying defense manufacturers with capital-intensive production lines and margin pressure from supply chains. They're buying software, data, and intelligence platforms that sit between the hardware primes and the decision makers. That distinction, services and software over manufacturing, is the entire thesis, and it's one that public market defense ETFs like ITA or XR only partially capture, because those indices are still weighted heavily toward the legacy primes. The actionable insight here: if you're building a defense allocation in a public portfolio, you need to consciously tilt away from the manufacturers and toward the software and services layer. Companies like Palantir, Leidos, KCI International, or Booz Allen itself, to approximate what Carlyle is actually buying. When you look at where institutional capital is concentrating inside defense right now, not just Carlyle, but Thoma Bravo, General Atlantic, and Vista Equity, all of whom have made defense-adjacent moves in the last 24 months. Three segments keep surfacing. First, C4ISR, which stands for Command, Control, Communications, Computers, Intelligence, Surveillance, and Reconnaissance. This is the nervous system of modern military operations. Global C4ISR spending is projected to reach $131 billion annually by 2028, according to defense market research firm Mordor Intelligence. The companies that own this layer, and they are mostly private or embedded inside larger contractors, are the ones that get called first when a new conflict theater opens. Second, cybersecurity with a federal mandate. This is not consumer cybersecurity. Federal agencies now operate under zero-trust architecture requirements mandated by Executive Order 14028, signed in 2021. Every agency has a compliance deadline. Most are behind schedule, and the vendors helping them get there are running backlogs measured in years. Companies like Palo Alto Networks, CrowdStrike, and smaller pure plays like Telos Corp derive meaningful revenue from this federal mandate. Carlyle's interest in this space is well documented. They've backed federal IT security platforms at multiple stages. Third, autonomous and unmanned systems. The Ukraine conflict effectively became a live proof of concept for drone warfare at scale, and the Pentagon's subsequent budget allocations reflect that. The FY 2025 defense budget included $1.8 billion specifically earmarked for autonomous systems procurement, a 34% year-over-year increase. The public market expression here is thinner, but companies like AeroVironment and Kratos Defense are legitimate proxies. The meta insight. All three of these segments share one characteristic. They're software-defined, high-margin, and defensible. That's what PE money chases. That should inform your public market selection criteria too. This is not financial advice. It's pattern recognition from watching where the most sophisticated capital in the world is pointing. Here's the part of the defense investing thesis that gets glossed over in every bullish breakdown, and I think it's genuinely important because the macro tailwind is real, but it doesn't eliminate execution risk or policy risk. Risk 1. Continuing resolution cycles. The U.S. government has operated under a continuing resolution, meaning a stopgap spending measure rather than a past budget, for a significant portion of the last decade. CRs typically freeze new program starts and procurement decisions at prior year levels. That sounds minor until you realize it creates lumpy, unpredictable revenue recognition for defense contractors, particularly smaller software and services firms that are still ramping programs. Any company telling you their defense revenue is perfectly linear is not being honest with you. Risk 2. Budget reconciliation pressure. Defense spending as a percentage of GDP has been declining in real terms since the post-9/11 peak. At roughly 3.1% of GDP currently, there is bipartisan political pressure, particularly in a fiscal tightening environment, to find cuts somewhere. Historically, IT modernization and administrative contracts get scrutinized first. The primes with hard production contracts are paradoxically safer in a budget cut scenario than the software vendors Carlyle prefers. Risk 3. Concentration inside defense PE. When every major PE firm moves into the same sector simultaneously, valuations compress returns. Carlyle paid 20x EBITDA for Mantech. If they're paying similar multiples today across a portfolio of similar assets, the exit math becomes harder unless they find strategic buyers among the primes or execute IPOs into a market that's receptive to defense software multiples. That IPO pipeline is your signal to watch. When Carlyle-backed defense assets start filing S1s, that's when the public market gets access to this thesis at scale. And that's when you want to already understand the fundamentals rather than chasing the IPO pop. Track the EDGAR filings, set up alerts, do the work before the crowd does. Before the outro, a quick word on something practical. If you're building a position in any of the names we've discussed, Booz Allen, KCI, Leidos, AeroVironment, you need a platform that doesn't eat your returns with commissions on rebalancing. I use Moomoo for a portion of my public market work specifically because their charting and options flow data is better than most retail platforms at no additional cost. They're also running a promotion right now where new accounts get free stocks on deposit. The link is in the description, and the sign-up takes about 4 minutes. Separately, if you want the full written version of the defense sector framework we use internally, including a watch list of public market defense proxies organized by segment, a risk-scoring methodology, and the PE exit pipeline tracker, that's available on our Gumroad at Synthetic Alpha. Gumroad.com. It's built for people who want to do the actual analysis, not just consume takes. Neither of these are sponsorships in the traditional sense. They're tools I'd tell you about if we were having this conversation over coffee. All right, back to it. We opened with a simple observation. Carlyle deployed more into defense than at any point in their history, And they weren't buying what you'd expect. By now, you know why. Software and services, not steel and production lines, and specifically C4ISR, federal cybersecurity, and autonomous systems. The risk framework gives you the other side of that trade. CR cycles, budget pressure, and valuation compression from PE crowding. The follow-up question this raises, and what we'll cover next, is how to read a defense contractor's backlog disclosure to separate durable revenue from contract risk. Subscribe so you don't miss that one. And if you want the written version, the newsletter is at syntheticalpha.io newsletter.